Two numbers are moving in opposite directions. One of them tracks the physical silver sitting in COMEX vaults, tagged and ready for delivery against futures contracts. This is registered inventory, metal that can be called upon when a contract holder demands actual delivery rather than cash settlement. It's the foundation on which the entire price discovery mechanism rests. Since July, that number has fallen by roughly 40%. The decline wasn't sudden. It happened gradually, a few 100,000 ounces at a time, week after week, without triggering the kind of attention that sharp moves generate. The consistency of the drawdown made it almost invisible. By the time the cumulative decline became significant, most market participants had already absorbed each incremental change as normal variation. The second number tracks open interest, the total number of futures contracts currently outstanding on the exchange. Each contract represents a claim on 5,000 ounces of silver. When open interest rises, it means more contracts are being written, more positions are being established, more paper claims are being created against whatever physical metal exists in the system. That number has been rising, not dramatically, not in the exponential way that precedes speculative blow-offs, but steadily, persistently, in a direction that creates an unusual mathematical relationship with the declining inventory. More claims, less metal. In most markets, this kind of divergence resolves quickly. Either inventory rises to meet the claims, or the claims decrease to match available inventory. The system finds equilibrium because participants have incentives to keep it balanced. But the COMEX silver market has been operating in this divergent state for months now. The imbalance isn't resolving, it's expanding. This is the kind of structural condition that doesn't generate headlines. The exchange continues to function normally. Contracts trade, prices move, settlement happens without disruption. From the outside, everything looks routine. The vulnerability is invisible until it isn't. Futures exchanges are designed to facilitate price discovery and risk transfer, not physical delivery. The vast majority of contracts are rolled forward or closed before delivery becomes relevant. The physical inventory exists as a backstop, a guarantee that the paper claims have substance, but it's rarely tested in meaningful size. What happens when it gets tested is a different matter. The last time COMEX silver inventory relative to open interest reached levels comparable to today was 1979 and 1980. That episode ended with emergency rule changes, forced liquidations, and a collapse in price that took years to recover from. The circumstances were different. There was an active attempt to corner the market then, but the structural condition was similar, more claims than metal. A system dependent on most participants never demanding what they're technically owed. No one is suggesting that history is about to repeat. The current positioning doesn't show the concentrated ownership that characterized the Hunt Brothers episode. The market structure has evolved, the safeguards are different, but the mathematical reality remains. When registered inventory falls and open interest rises, the ratio between them changes in ways that create potential energy. That energy may never be released. The imbalance may resolve quietly through inventory additions or position reductions without anyone noticing, or it may not. The exchange is pricing silver as if the current inventory is sufficient. The behavior of the inventory itself suggests otherwise. Something in this equation will eventually give. The question is what and when. To understand why this divergence matters, you first have to understand why it usually doesn't. The COMEX silver market is not primarily a physical market. It's a derivatives market that happens to have a physical delivery mechanism. The distinction is crucial because it shapes how participants behave and what the inventory numbers actually mean. On any given day, the trading volume in COMEX silver futures exceeds the entire registered inventory many times over. This isn't unusual or problematic. It's how futures markets are designed to work. The contracts represent price exposure, not an immediate claim on metal. Traders use them to hedge, speculate, and manage risk, without any intention of taking or making delivery. The physical delivery option exists primarily as a price anchoring mechanism. It ensures that futures prices can't diverge too far from physical reality because, at the extreme, someone could always demand actual metal. This threat of delivery keeps the paper and physical markets connected. But the threat is rarely exercised at scale. Delivery on COMEX silver contracts requires specific procedures, timing, and logistics that make it impractical for most participants. You need approved vault relationships. You need to navigate the delivery window. You need to handle the physical metal once you receive it. For most traders, these frictions outweigh any benefit from taking delivery. The result is a market where 95% or more of contracts are closed or rolled before delivery becomes relevant. The registered inventory, while theoretically available, is almost never claimed in size. This is why the inventory to open interest ratio usually doesn't matter. In normal conditions, the ratio can fluctuate significantly without affecting market function. Registered inventory might fall for technical reasons, metal being reclassified, moved between facilities, or shifted to eligible status. Open interest might rise during periods of high volatility when more participants want exposure. The ratio changes, but the change has no practical impact because delivery demand remains minimal. Market participants understand this. Analysts who track COMEX data have learned to ignore short-term fluctuations in the ratio. The focus stays on price, on trading volume, on positioning data that indicates directional views. The inventory serves as backdrop rather than driver. For years, even decades, this framework has held. The physical delivery mechanism has remained theoretical for most participants. The inventory has provided sufficient backstop for the rare occasions when someone does stand for delivery. The system has functioned without the kind of stress that would test its limits. This history creates complacency. When registered inventory declines, the default interpretation is that it doesn't matter. The market has operated with varying inventory levels before. Delivery demand has remained low regardless of how much metal is available. The relationship between paper and physical has stayed stable through multiple cycles. The assumption, embedded so deeply that most participants don't even recognize it as an assumption, is that this stability will continue, that delivery demand will remain a small fraction of open interest, that the inventory, however low it falls, will always be sufficient for actual needs. This assumption is probably correct, but probably is not, certainly. And the current divergence, inventory falling while open interest rises, is creating conditions where the assumption matters more than it has in years. When most participants ignore a metric, and that metric starts moving in an unusual direction, it creates an information asymmetry. Those who notice are operating with different expectations than those who don't. The gap between these expectations is where market dislocations originate. The inventory to open interest ratio usually doesn't matter, until, on rare occasions, it becomes the only thing that matters. The deviation becomes clear when you examine the velocity of the divergence. Registered silver inventory on the COMEX stood at approximately 35 million ounces in July. By recent count, that figure has fallen to roughly 21 million ounces, a decline of 14 million ounces in a matter of months. During the same period, open interest in silver futures has increased by approximately 15%, more contracts outstanding, more paper claims written, more theoretical demand for a shrinking pool of deliverable metal. These two movements, happening simultaneously, create a ratio that is approaching territory not seen in decades. The coverage ratio, the number of ounces of registered silver available per ounce of open interest, has compressed to levels that would have seemed implausible 2 years ago. Each contract represents 5,000 ounces. When you divide registered inventory by total open interest converted to ounces, the resulting number tells you how much physical metal backs each unit of paper claim. That number has been falling steadily, and it's now low enough that even modest delivery demand could create friction. Here's where the anomaly becomes structural rather than statistical. In a healthy futures market, the coverage ratio fluctuates but tends to revert. When inventory falls too low relative to open interest, arbitrage mechanisms activate. The price of immediate delivery rises relative to future delivery, a condition called backwardation. This price signal incentivizes inventory additions. Metal flows into registered status. The ratio normalizes. Alternatively, if inventory can't be replenished, the cost of carrying short positions rises. Participants reduce open interest rather than face delivery obligations they can't meet. The ratio normalizes from the other direction. Either way, the system self-corrects. The divergence resolves. What's unusual about the current situation is that neither correction mechanism is operating effectively. Backwardation has appeared intermittently, but it hasn't been sustained or deep enough to trigger significant inventory additions. Metal isn't flowing into registered status despite the price signals that would normally attract it. The incentive exists, but the response is muted. Simultaneously, open interest continues to rise rather than fall. Participants are adding positions, not reducing them. The delivery risk that comes with short positions in a low inventory environment isn't constraining behavior the way it normally would. This is the anomaly, not the low inventory itself, not the high open interest itself, but the failure of the normal equilibrating mechanisms to resolve the divergence. When a system's self-correction mechanisms stop functioning, it means something about the underlying conditions has changed. The model that participants use to assess risk may no longer match reality. The assumptions built into standard behavior may no longer hold. The market is telling us, through the persistence of this divergence, that something is different this time. Not necessarily worse, not necessarily headed toward crisis, but different in a way that the normal frameworks aren't capturing. One possible explanation is that the metal simply isn't available. Registered inventory represents silver that owners have specifically designated for potential delivery. It's not all the silver in COMEX vaults. That larger number is eligible inventory, which includes metal stored but not earmarked for delivery. Owners can convert eligible to registered, making more metal available for delivery whenever they choose. If eligible inventory were also low, the explanation would be simple scarcity. But eligible inventory remains substantial. There's metal in the vaults. It's just not being made available for delivery. This suggests that the owners of that metal, whoever holds the warehouse receipts, have decided that keeping it in eligible status serves their interest better than converting it to registered. They're choosing to withhold supply from the delivery mechanism. Why would they make that choice? Possibly because they expect higher prices and want to sell later. Possibly because they need the metal for other purposes and don't want it locked into delivery obligations. Possibly because they're uncertain about their ability to replace it if they deliver. Whatever the reason, the decision to keep metal ineligible rather than registered status, even as the coverage ratio compresses and price signals suggest conversion would be profitable, is itself a form of information. It's telling us that the holders of physical silver value possession more than the arbitrage profit they could capture by making it available for delivery. That's unusual. Arbitrage profits are supposed to drive behavior in commodity markets. When they don't, it suggests that the participants with actual metal are operating on a different calculus than the participants trading paper claims. The divergence between those two calculi is what creates the structural vulnerability. The most direct historical parallel is 1979 and 1980. The comparison is imperfect, but it illuminates the dynamics that matter. In the late 1970s, Nelson Bunker Hunt and his brother William Herbert Hunt began accumulating silver positions on a scale that had never been attempted. They bought futures contracts. They took delivery of physical metal. They accumulated positions through foreign entities and complex structures that obscured the total size of their holdings. At their peak, the Hunts controlled an estimated 100 to 200 million ounces of silver, a significant fraction of total world supply. Their buying drove prices from around $6 an ounce in early 1979 to nearly $50 by January 1980. The COMEX silver market during this period experienced exactly the kind of divergence we're discussing now. Registered inventory fell as the Hunts and their associates took delivery. Open interest remained elevated as other participants traded against the trend or attempted to profit from the volatility. The coverage ratio compressed to levels that made the exchange's delivery mechanism genuinely precarious. What happened next has become a cautionary tale in commodity market history. In January 1980, the COMEX changed its rules. The exchange imposed position limits, specifically targeting the Hunts' holdings. It restricted trading to liquidation only. Participants could close positions but not open new ones. The exchange, facing a potential failure of its delivery mechanism, intervened directly to force the unwinding of concentrated positions. Silver prices collapsed. The Hunts faced margin calls they couldn't meet. The positions that had driven the market higher became forced sellers at exactly the wrong moment. Within weeks, silver had fallen by more than 50%. Within months, the Hunts were in bankruptcy proceedings. The lesson typically drawn from this episode is about speculation and hubris. The Hunts overreached. They tried to corner a market that was too large to corner. They were crushed by the forces they had set in motion. That lesson is valid as far as it goes, but it obscures a more structural point. The exchange changed the rules because the delivery mechanism was at risk of failing. Too many claims, not enough metal. The coverage ratio had fallen to levels where actual delivery demand could have exceeded available supply. The exchange faced a choice between intervention and potential default. It chose intervention. The rules changed mid-game. Participants who had established positions under one set of assumptions found themselves operating under a different set entirely. This is the part of the history that matters for understanding the current situation. Exchanges are not neutral infrastructure. They're institutions with survival imperatives. When the integrity of their core function, price discovery and delivery, is threatened, they will act to protect themselves. The rules that govern trading are not fixed. They're contingent on conditions remaining within certain parameters. When conditions move outside those parameters, everything becomes negotiable. The Hunts learned this the hard way, but the dynamic isn't unique to their situation. Anytime a commodity exchange faces a coverage ratio crisis, the same pressures emerge. The same options present themselves. Intervention becomes not just possible, but probable. This doesn't mean history will repeat. The current situation differs from 1979-1980 in critical ways. There's no concentrated position visible in the data today. Open interest is distributed across many participants rather than controlled by a few. The regulatory environment has evolved, with position limits and reporting requirements designed to prevent Hunt-style accumulation. The market structure includes mechanisms that didn't exist 40 years ago. But the underlying vulnerability, too many claims against too little metal, creates similar dynamics regardless of what caused it. The specific trigger matters less than the structural condition itself. In 1980, the trigger was concentrated ownership attempting to squeeze the market. Today, if a trigger emerged, it would likely look different. Perhaps a surge in industrial delivery demand. Perhaps a coordinated decision by multiple participants to stand for delivery. Perhaps an external shock that changed the calculus around physical possession. The trigger is unpredictable. The vulnerability is observable. There's a second historical reference point worth considering, though it's less dramatic and less often discussed. In 2011, during silver's run toward $50, the coverage ratio also compressed significantly. Registered inventory fell as investment demand surged. Open interest fluctuated but remained elevated relative to available metal. The resolution was different than 1980. There was no rule change, no forced liquidation. Instead, prices rose high enough that delivery demand naturally subsided. Participants who might have stood for delivery found it more profitable to sell their contracts into the rallying market. The coverage ratio normalized through price adjustment rather than intervention. This outcome is also possible today. If prices rise sufficiently, the incentive to demand delivery diminishes. Paper profits become more attractive than physical possession. The system rebalances through market mechanisms rather than administrative action. The question is which resolution path the current divergence will follow: the 1980 path of intervention and forced liquidation, the 2011 path of price adjustment and voluntary rebalancing, or something else entirely. The data doesn't tell us which outcome is coming. It only tells us that the conditions for something significant to happen are present. There's a second data stream that rarely gets discussed alongside COMEX positioning, but it's been moving in a way that adds dimension to the inventory divergence. The Shanghai Futures Exchange maintains its own silver contract, with its own delivery mechanism, its own inventory tracking, and its own participant base. The two markets are connected through arbitrage, but they operate under different rules, different time zones, and different regulatory frameworks. For most of the past decade, the Shanghai and COMEX markets have moved in loose correlation. When one showed inventory stress, the other often provided relief. Metal flowed between jurisdictions as arbitrageurs exploited price differences. The global silver market, despite being fragmented across exchanges, functioned as a connected system. That connection has been weakening. Shanghai silver inventory has been declining on a trajectory that parallels COMEX, not offsets it. The arbitrage flows that would normally rebalance supply between East and West have diminished. Metal, that might previously have moved to whichever exchange offered better delivery economics, is instead staying put or disappearing from exchange systems entirely. This is where the convergence becomes significant. If COMEX inventory were falling while Shanghai inventory was rising, the explanation would be straightforward. Regional demand shifts, arbitrage in action, metal moving to where it's most valued, the global system rebalancing itself. But both are falling. The two largest exchange-based silver inventories in the world are declining simultaneously, even as open interest in both markets remains elevated. This isn't arbitrage. This is something structural happening to physical silver availability across the entire exchange-traded system. There's a third signal that connects to this pattern, though it requires looking at a different market entirely. The London bullion market operates differently from COMEX or Shanghai. It's an over-the-counter market where participants trade directly with each other rather than through a central exchange. There's no official inventory tracking, no public open interest data. The market is opaque by design. But London is where the largest physical silver flows occur. It's where refiners deliver metal to industrial users, where mining companies sell production to dealers, where central banks and sovereign wealth funds, when they participate in precious metals, typically transact. Information from London comes in directly, through lease rates, through forward curves, through the reported behavior of market makers. These signals are noisy and difficult to interpret, but they have been suggesting tightness that aligns with what COMEX and Shanghai inventory data show more directly. Silver lease rates, the cost of borrowing physical metal, have been elevated relative to recent history. Not dramatically, not at crisis levels, but persistently higher than the near-zero rates that characterized the market for most of the past decade. Someone is willing to pay more to borrow silver than they used to. Elevated lease rates mean that physical silver has become more valuable to hold. Holders are demanding compensation for lending it out. The premium on immediate possession versus future claims has increased. This connects back to the COMEX registered inventory question. If lease rates are elevated in London, it provides an alternative explanation for why eligible inventory isn't being converted to registered status. Owners can earn a return by lending their metal in the OTC market rather than making it available for exchange delivery. But that explanation, while technically valid, doesn't resolve the underlying concern. It just relocates it. The metal isn't unavailable because it's disappeared. It's unavailable because holders have found more attractive uses for it than backstopping futures contracts. Either way, the coverage ratio at COMEX reflects a real condition. Deliverable silver is scarce relative to claims, regardless of why it's scarce. The convergence across these three markets, COMEX, Shanghai, and London, creates a picture that no single data source would provide alone. Each market is telling a version of the same story. Physical silver is tighter than it has been in years. The availability of metal for immediate delivery, across multiple jurisdictions and market structures, has declined. This doesn't predict what happens next. Markets can remain tight without breaking. Prices can adjust gradually to reflect new realities. The system can adapt without crisis. But the convergence matters because it eliminates certain explanations. This isn't a COMEX-specific technical issue. It isn't a regional imbalance that arbitrage will correct. It isn't a temporary fluctuation that will mean revert on its own. It's a global pattern. And global patterns require global explanations. The most parsimonious explanation is that demand for physical silver from industrial users, from investors, from entities we can't directly observe, has increased relative to the supply being made available to exchange systems. The metal exists somewhere, but less of it is being offered for delivery than the market requires. That condition can persist indefinitely at the right price. Silver isn't being consumed faster than it's being produced in any absolute sense. The question is what price is required to pull metal out of wherever it is currently held and into the channels where it can be delivered against contracts. The divergence between registered inventory and open interest is measuring the gap between the current price and that equilibrium price. The wider the divergence, the larger the gap, and the gap has been widening. This analysis has followed a thread of evidence toward a conclusion that feels increasingly obvious. Registered inventory is falling. Open interest is rising. The coverage ratio is compressing. Multiple markets are showing parallel tightness. The structural vulnerability is clear, but obvious conclusions in markets are dangerous precisely because they feel inevitable. The pattern recognition that makes the case compelling is the same cognitive process that finds patterns where none exist. Here's what this analysis doesn't establish. First, the declining registered inventory doesn't mean silver is actually scarce in any fundamental sense. Above-ground silver stocks, the total amount of refined silver held by various entities around the world, are measured in billions of ounces. The COMEX registered inventory, even at its peak, represents a tiny fraction of this total. The decline we've been tracking is a decline in the specific subcategory of metal that owners have chosen to make available for futures delivery. This is a statement about holder behavior, not physical scarcity. The metal exists. It's simply not being offered. That's a very different condition than genuine shortage, and it responds to different incentives. If prices rise enough, behavior changes. Metal currently held as investment or leased in the OTC market or sitting in eligible status gets reclassified and made available. The registered inventory that looks dangerously low today could normalize quickly if market conditions make delivery profitable for holders. Second, the rising open interest doesn't mean that all those contracts will stand for delivery. Open interest measures outstanding positions, not delivery intentions. The vast majority of participants holding silver futures have no interest in taking physical metal. They're trading price exposure. When their contracts approach delivery, they'll roll or close just as they always have. The coverage ratio calculates a theoretical vulnerability. What would happen if everyone demanded delivery simultaneously? But that scenario has never occurred and almost certainly never will. The relevant question isn't whether registered inventory could cover all open interest. It's whether it can cover the small percentage of open interest that might actually stand for delivery. Historical data suggests that percentage is low. Even in periods of elevated delivery demand, actual deliveries have represented single-digit percentages of open interest. If that pattern holds, the current inventory is more than adequate. The analysis we've presented assumes something could cause that percentage to increase, but assumptions about unprecedented behavior should be held skeptically. Markets have developed mechanisms to discourage delivery precisely because most participants don't want it. Those mechanisms remain intact. Third, the historical parallel to 1980 is both instructive and misleading. The Hunt brothers created a specific set of conditions: concentrated ownership, aggressive accumulation, explicit intent to squeeze the market, that doesn't exist today. Position limits and reporting requirements make it nearly impossible to replicate their strategy. The regulatory environment has evolved specifically to prevent that scenario. Drawing lessons from 1980 about exchange intervention is valid, but expecting the same sequence of events to unfold ignores 40 years of market evolution. The vulnerabilities are different. The participants are different. The most likely resolution paths are different. Fourth, the convergence across markets, while notable, has alternative explanations that don't require crisis scenarios. Industrial demand has increased, particularly from solar manufacturing. This could explain the parallel inventory declines without implying any breakdown in market function. Supply is simply being absorbed by end users rather than held in exchange warehouses. Investment demand has also increased, but it's flowing into forms that don't appear in exchange data. Private vaults, allocated accounts, physical coins and bars held outside the system. The metal is being accumulated, just not in places where our metrics capture it. These explanations don't contradict the data. They contextualize it. The same observations that look alarming through one lens look like healthy market adaptation through another. Fifth, many previous predictions of COMEX delivery crises have failed to materialize. This is perhaps the most important caveat. For at least 2 decades, analysts have periodically warned that COMEX silver inventory was insufficient, that the paper-to-physical ratio was unsustainable, that a delivery squeeze was imminent. Each time, the predicted crisis didn't occur. The market adapted, prices adjusted, the system continued functioning. This history doesn't mean the current analysis is wrong. Structural vulnerabilities can persist for extended periods before producing consequences. Past stability doesn't guarantee future stability, but it should temper confidence. The pattern of warning and non-event has repeated enough times that skepticism toward dramatic conclusions is warranted. The default assumption that the market will muddle through, as it always has a strong track record. What we're left with is genuine uncertainty. The data shows a divergence that's unusual by historical standards. The structural vulnerability it implies is real. The possibility of disruption exists in a way it didn't 2 years ago, but possibility isn't probability, and probability isn't certainty. The most likely outcome remains that the divergence resolves without drama through price adjustment, inventory normalization, or simple continuation of current patterns. The value of this analysis isn't in predicting crisis. It's in identifying conditions where outcomes other than the default become possible. Not likely, not imminent, but possible in a way that warrants attention. If the structural conditions described here matter, certain observable markers should emerge in the coming months. Not predictions of specific events, but areas where the thesis would either strengthen or weaken based on new data. The first thing to watch is the behavior of the coverage ratio itself during delivery periods. COMEX silver futures have specific delivery months when contracts can be settled with physical metal. March, May, July, September, and December are the active months. During these windows, participants who hold contracts through the delivery period must either roll their positions forward, close them, or stand for delivery. The ratio of delivery notices to open interest during these windows provides direct information about participant behavior. If delivery demand increases, if a larger percentage of open interest stands for metal rather than rolling, it would confirm that the coverage ratio compression is creating real pressure rather than theoretical vulnerability. Watch for delivery statistics that exceed historical norms, not by small margins, but by multiples. A doubling or tripling of delivery demand, even from a low base, would signal that something has changed in how participants value physical possession versus paper exposure. The second area to monitor is the relationship between spot prices and nearby futures contracts. In normal conditions, futures contracts trade at a slight premium to spot prices, reflecting the cost of carrying inventory, storage, insurance, financing. This condition is called contango, and it's the default state for most commodity markets. When physical metal becomes scarce relative to demand, this relationship can invert. Nearby contracts trade at a premium to deferred contracts. Spot prices exceed futures prices. The market enters backwardation. Sustained backwardation in silver would indicate that immediate possession has become more valuable than future claims. It would confirm that the inventory tightness visible in registered stocks is translating into real market stress. Brief episodes of backwardation occur periodically and often mean little. The signal to watch for is persistence. Backwardation that lasts weeks rather than days, that deepens rather than resolves, that resists the arbitrage forces that normally eliminate it quickly. The third observation point is the spread between COMEX prices and physical premiums in the retail and industrial markets. When exchange inventory is adequate, the premium for physical silver over spot prices remains stable and modest. Dealers buy at spot, add their margin, and sell. The spread reflects logistics and profit, not scarcity. When exchange inventory tightens, these premiums can widen dramatically. Dealers who source metal from the physical market rather than the exchange find that metal costs more to acquire. They pass those costs through. The gap between the paper price and the price of actual metal in hand expands. This happened notably in early 2020 and again in early 2021. Physical premiums spiked while spot prices remained relatively stable. The divergence revealed that the paper market and physical market were experiencing different conditions. If physical premiums begin expanding again, particularly for the industrial-grade silver that manufacturers require, it would suggest that the COMEX inventory decline is creating real supply friction beyond the exchange itself. None of these markers would prove that a delivery crisis is imminent. Markets can show stress signals and still resolve without drama. The observations are diagnostic, not predictive, but they are the places where evidence would accumulate first, where the structural vulnerability we've described would become visible before it became obvious. The discipline is to watch without forcing conclusions, to update assessments as data arrives rather than defending a thesis regardless of evidence, to hold the possibility of disruption without assuming its inevitability. We started with two numbers moving in opposite directions. Registered silver inventory falling 40% since July. Open interest rising through the same period. A coverage ratio compressing to levels that create structural vulnerability, even if that vulnerability may never be tested. What we found was a condition that most market participants aren't watching. The mechanism that connects paper claims to physical metal is under pressure that does not appear in price charts or standard positioning data. The divergence is real, measurable, and historically unusual. The parallels to 1980 are instructive but not determinative. The conditions that led to exchange intervention then don't exist in the same form now. But the underlying dynamic, more claims than metal, creates similar potential energy regardless of what caused it. The convergence across markets adds weight to the observation. COMEX, Shanghai, and London are all showing signs of physical tightness. This isn't a localized technical issue, it's a global pattern in exchange available silver. But patterns aren't predictions. The most likely outcome remains that the market adapts as it always has. Prices adjust, inventory normalizes, the divergence resolves without crisis. What's different now is the scale of the divergence and the duration of its persistence. The self-correcting mechanisms that normally rebalance these conditions have been operating slowly, if at all. The gap between paper and physical has been widening rather than narrowing. This doesn't mean something will break. It means the conditions exist for something to break, if sufficient pressure is applied. The institutions and industrial users navigating this market understand the distinction. They're not predicting delivery failures or exchange interventions. They're simply operating with awareness that the margin of safety has narrowed. That assumptions which held for decades may not hold indefinitely. That structural conditions deserve attention even when immediate prices suggest calm. That's the appropriate conclusion from this analysis. Not alarm, not prediction. Awareness. The COMEX silver market continues to function. Prices are set, contracts trade. Settlement occurs without disruption. From the surface, everything appears normal. Beneath the surface, the numbers tell a different story. One that may never become the dominant narrative. One that may resolve quietly while attention is elsewhere. Or one that may matter considerably when conditions change. For now, it's simply a divergence worth watching. Two numbers, opposite directions. Something eventually will give.